Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional and owner of Shepherd Wealth Management. Very excited to be back here in the studio doing today's podcast because, you know, we're just in a bear market here as we wake up on Monday. How you doing this morning?
Bearish, my friend.
That is the feeling. But, you know, bad times don't last forever. We're going to talk a little bit about that today. So this is why we do this show, is for moments just like this. It's easy to do this job and to be a long-term investor when everything's moving up and to the right, nice and rosy, like it has over the last 3 years. And times like now are, inevitable.
Inevitable. And as a wiser person once told me, game plans are for when it hits the fan, not for when things are going good. So hopefully the viewers and listeners of the show are also appreciative of your steady advice and guidance. I know we're going to get in a little bit of that today as we navigate the waters of Monday morning.
Absolutely.
You know, it's kind of funny. I think about a bear market and I just think about a bear ripping me to shreds, not hibernating, which I'm assuming is a little more of where that, moniker comes from. Yeah. But either way, don't poke the bear, but also pull out your buy sheet. So
maybe just, invest in Yetis because those are bear proof.
Yeah. Bear proof lottery tickets, Jim Beam,
Yeah. Well, maybe a little bit of all the above, but yeah, we're definitely going to get into some good stuff today. So I think we're starting with announcements. Is that right, Ez?
Yeah. Why don't you tell the people, listeners and SWM fans about what happened on Friday?
Yeah, Friday was great. Friday was the inaugural, I guess we'll call it that.
Yeah.
What we're calling the Financial Shepherd Happy Hour. So on Fridays, what I'm going to start to do, every Friday going forward, and you can find this on our YouTube page as well, or just go to shepherdwm.com. There's a link to the YouTube page right on our website. But every Friday, just for maybe 15, 25 minutes, short and sweet, like what happened during the week, share some insight as to how we're handling things here for clients at Shepherd Wealth Management, just to kind of give you a real quick synopsis of what happened, why did it happen, and are there opportunities for you to benefit from some of the data that we'll be sharing with you as well. So very, very exciting. Got a lot of really good feedback on the first one, and we'll be doing that live on Friday on YouTube. So text in your questions if there are certain things that you want to make sure that we're talking about, 513-630-2664, and we'll make sure that we spend some time addressing those questions as well.
Yeah, that's right. It's an additional live show we're going to be now doing weekly. Sometimes, we take breaks in the podcasts for holidays, things of that nature, but the happy hour will be happening weekly. You can get to it straight through our YouTube live channel, the Shepherd Wealth Management YouTube. So every Friday about 4:15, as soon as that bell sounds us off for the week, we're going to be on there having our reactions and just chilling out.
Feel free to pop a Diet Coke, LaCroix, your favorite beverage of choice. It is, Friday happy hour.
Oh man, I know it's going to sound gross. I do love that coconut LaCroix though. That's like one of my favorite.
That's not my jam, but to each their own.
Yeah.
So that's exciting. Look out for that. And then, I think the news of the day is kind of self-explanatory.
Right. Yeah. It doesn't look like there's anything kind of under the currents that maybe is going to go by people's eyes today. It's a little right out there in the open, huh?
Yeah. And we're going to talk about that today. So obviously what we're referencing here, the NASDAQ's down more than 30% from its high. So it's been in bear market territory for quite a while at this point so far this year. And now the S&P 500 is intraday bear market. We'll see where it actually closes at. But right now, across the board, all sectors are down here. So it is definitely a bearish way to wake up on a absolutely very nice, gorgeous day here. Super hot. You're definitely feeling the humidity here in the Cincinnati, Northern Kentucky area right now. But
you do. That's some of my favorite weather. I spent 2 summers in southeast Louisiana with no AC. I had a lot of fans and ice in my drinks. But other than that, I love the hot and humid, man. The more the better to a degree.
I agree. I completely agree with that. It's better than being cold, at least in my opinion. But Can you
imagine dealing with this market and it's like 2 degrees outside? Oh my gosh.
I'm sure somebody is somewhere.
Yeah.
But so the news is pretty straightforward. Obviously we're in bear market territory, at least intraday on the S&P, as I mentioned. Even, the energy sector, which is the only sector so far this year that's been positive, is actually down today. So we'll actually see what actually happens here with the Federal Reserve later this week. Likely going to be announcing a rate hike increase. I think the question that the market's trying to answer right now is the Fed going to stick with their 50 basis point increase this month and next month, like they had told us they were going to do during their last meeting? Or are they going to shift gears a little bit because inflation data that we got last Friday came in super hot, They were expecting 8.2%. It came in at 8.6%.
Yeah.
So that's kind of what the market's reacting to right now is the Fed actually going to increase the rates, this week from 50 to maybe 75 or even a full 1% like a lot of people are calling for. So that's why we're seeing the volatility, and we're going to talk more about that throughout this podcast. But there's your short and sweet reason why things are going the way that they're going here at the start on this Monday.
Well, let's just get into the deep end. I mean, what are your opinions on the inflation? Or the interest rates? You think a higher hike is necessary, or what do you think?
I mean, basically what Powell's trying to do is land the plane on a very, very, very thin runway to hopefully not put the whole economy into a recession. Now, recession, people get all worried about that. Obviously, it's not a great thing for stockholders in the moment, but recessions are inevitable, right? You cannot avoid them if you're a long-term investor. And only in hindsight we'd be like, oh yeah, that's the thing that caused that recession. Mm-hmm. One of the things that's keeping us afloat on the recession standpoint is the fact that we have historically low employment rates. Like unemployment rate's 3.6%, which is right where we were pre-pandemic.
Right.
So it's very, very difficult for me at least to look at this market, even though it's not a great environment for stocks with inflation at 40-year highs, the Fed's increasing rates and all these other things. Actually, banks around the world are increasing their rates, not just here in the United States. So it's hard for me to say that this is the year that we're going to see the recession, but recession is inevitable. It's just a question of how you're going to respond to that. And by having a game plan, which is what the main topic of today is going to be all about, is really what's going to separate those that have long-term success versus those that really just throw their hands up and say this is all rigged or whatever the case may be, which in reality we know it's not. So that's why we're doing this show. I do this show for this specific reason, so people are informed, they have the right information, they can look at things a little differently, maybe a little bit more logically based on history and what the market's done in similar moments like this, so that you can position yourself to handle the volatility and ultimately come out the other side when we do get the inevitable recovery. Because after every single recession, there's always been a recovery. So we've talked about it many, many times. You can't bet on the end of the world. Even if you get it right, you're not going to collect from anybody anyway. So
yeah, that's just it. I mean, I'm just so shocked about some of the reactions, we're seeing where calling for the greatest economic collapse since Rome.
We recently got that, right?
Because we did a little bit of that on the comments on the YouTube.
Yeah. Was that the happy hour comment?
I don't believe so. I think it was some of the shorter daily kind of highlights that we post.
I know. I laugh at that, and I laugh because that's the reason why I'm doing this podcast is for that person. I think they just saw a clip, like a 30-second clip, where I think I said I'm not calling for a recession in 2022. I mean, it might happen. I don't know. There's reasons why I think it won't happen, but inevitably it will happen. Is it going to be 2023? Is it going to be 2024? I don't know, maybe. But that's the reason why we do the show, is so that people don't have that emotional knee-jerk reaction. I think we got one of those reactions on our YouTube post there. So I hope the dude, I think is what his name was, actually maybe watches the full clip, because I don't mix words too much. I'm pretty direct and kind of how we handle things. So
yeah, very clear. There's not any ambiguity in your podcast, and I think that's why we've seen so much success. With the viewership that we've had. But I can understand maybe where the dude is coming from, especially if, I'm not trying to in any way project on them their circumstances, but, you are very kind to the people out there, and you make your knowledge about finance and personal finance and wealth management available to everyone, which, like you said, is a whole purpose of this show.
Yeah.
And I know there's a huge generation of people out there, specifically millennials, that feel disenfranchised in so many different ways and maybe haven't been able to, for whatever reason, put into their investments, their finances, the way that they feel like, their parents did at their age. So again, I'm totally painting this portrait of this person who we don't know who they are, but you look on the news and all you see is the doom and gloom, because that's what gets people to tune in.
Correct.
And then, I know for myself, being an older millennial, there are times when I'm just like, well, man, when is this going to really work out for me? Anyway, I can see where my whole point is. Excuse me for rambling. This is Joshua's show, not the Ez show.
Yeah, don't project on anyone.
Yeah, I'm not
projecting.
But I can definitely see where that kind of mindset and that sentiment and that fear is coming from, because I had it.
Sure.
I totally had it.
And I do too. I mean, I'm a human being, right? I am hardwired just like everybody else with the fight or flight, this fear and greed, which is what behavioral finance would call that. So we actually know, thanks to the studies that they've done in behavioral finance, people won, economic Nobel Prizes for this kind of stuff.
Right.
That we feel our losses twice as much as we feel good about our gains, which is, again, why people have these sort of, emotional reactions. And that's just not a good strategy, right? If you're letting your emotions get the better of you when it comes to investing, even if you're a long-term investor, that's absolutely the wrong thing to do. And that's why I want to talk about what we're getting ready to talk about right now. So I came across some awesome data in preparation for the Friday Happy Hour show. Came from State Street. And I wanted to share some of this information with you. So we always talk about there's really only two things that investors can control. We could sit here for days on days and talk about all the stuff that we cannot control when it comes to investing. But at the end of the day, there are two things that are very important that will lead to long-term success if you can do them successfully. One is temperament, so controlling those emotions. And the second is your asset allocation. And for those of you that may be watching this show for the first time, asset allocation is just a fancy way of saying this is how much of my money is invested in stocks versus bonds and cash. There's this whole concept that also won an economic Nobel Prize. Came out in 1952. Professor Harry Markowitz brought the idea of modern portfolio theory to the table. And basically what he was able to prove is that for long-term investors, your asset allocation will explain 94% of the variability of your returns. And the great news is you're always in control over your asset allocation, that percentage of money invested in stocks, bonds, and cash. So if you can control the allocation, it helps you control performance over a long period of time, at least gives you a reasonable range of outcomes that you should expect with any given asset allocation. And it'll also help you control the risk that you're taking to achieve that long-term performance, which is really what most people are looking for. In my experience, over 10 plus years of working with probably thousands of clients at this point, almost everyone has a goal, whatever the reason is for their money to be at risk invested in the market. Oftentimes it's things like retirement and college and homes, et cetera. But they never really know how much risk they need to achieve to actually get that performance. So that's what modern portfolio theory will help you with. That's absolutely the backbone of the strategy that we employ here at Shepherd Wealth Management. And since we're on this topic of asset allocation, I got some interesting data to share. And this is something that we talked about during the Friday Happy Hour. So I want to re-share this with everybody because I thought it was pretty compelling. So an asset allocation of 20% stock exposure and 80% bond exposure, which is pretty much the most conservative. I mean, of course, somebody can have 100% bond exposure, but for financial planners such as myself, like when we're working with clients at a Fidelity or a TD Ameritrade, one of those large institutions, this is pretty much the most conservative asset allocation that's out there because, you still want to have some stock exposure, even if you're super conservative, mostly due to the fact that stocks are the best way historically to keep up with inflation. So a 20% stock exposure allocation, 80% bonds. And this is as of the end of May, this data here.
All right.
So that allocation is down 12% year to date. Now, why is that significant? Is because in its entire history, I guess as far back as data can go, that asset allocation's worst year was minus 5%.
Oh.
So now we're more than 2x, and we're only at, the middle of June here. More than 2x worse performance than the history of that asset allocation, which is staggering. So let's compare that to other asset allocations. So 60-40, so 60% stocks, 40% bonds. I think I mentioned this before. That's the most recommended asset allocation for decades from financial planners for those that are retired. So if you're retired for decades upon decades, financial advisors have been like, hey, 60% stocks, 40% bonds is a good allocation. And there's very specific reasons for that. Probably won't get into here today unless there's somebody that has that question. But 60% stocks, 40% bonds year to date. Again, as of the end of May, I got to put on the readers here real quick, Az.
Who's an older millennial now?
Yeah, that's right. So that asset allocation, 60% stocks, 40% bonds, is down 15% year to date. Which is, again, if we compare that to that 20 stock, 80% bond allocation, it's only a 3% difference in performance thus far, but you're taking on 3 times, the stock exposure.
Right.
With 60-40. And then if you do the exact opposite allocation, right, 80% stocks, 20% bonds, That's down 16% year to date. Again, that's only 4% difference in performance, but you're taking on, 4 times the stock exposure. So these numbers are just odd, right? That's all you can do is say wow. And I think Charlie Munger said it best in the most recent annual stakeholder meeting for Berkshire Hathaway, Class A shareholders. Somebody asked a question about what his thoughts in the market, so far this year. And he said, if you're not confused at this point, you're really just not paying attention, because this is odd, where you have stocks down, officially bear market territory if it closes, if the S&P closes at this level. Official bear market, NASDAQ's been in a bear market. This is just an odd time where you see the stock market being down. You're losing in bonds. Bonds are down 10%, approximately here year to date. And you're losing in cash because inflation's at over 8%, right? So there really is not been a place to hide out in this market in any way, shape, or form.
No.
Except for there is one sector, the energy sector. Is the only sector that's positive. And mainly the reason for that, it has a lot to do with what's going on over there in Ukraine, which is terrible. Hopefully they come to some sort of resolution. But even if they come to a peaceful resolution, that doesn't mean that energy prices are all of a sudden going to come back down to where they were before all this stuff happened.
Right.
So how do we handle all this? I think it's probably what everybody wants to know.
Yeah, what do we do?
So there's a couple different things that we can do. So we talked about controlling the asset allocation. Well, part of that for taxable accounts, for those that have individual joint accounts, trust accounts, anything that's not a retirement account, you can utilize a process called tax loss harvesting. So tax loss harvesting, what is that all about? So let's say you have position, in Apple, right? Apple's down this year, I think probably close to 20% or more at the moment. I have to pull the numbers. All right, so Apple's down, right? And maybe it's a new position for you. You got into Apple because it's the largest position in the S&P 500 or whatever your reason was. Mm-hmm. So Apple's down. What you can do is you can take the loss. You can sell Apple. You're going to show a loss, right? Because you recognized a loss. Maybe you purchased it at, $170 a share, and now it's worth $140 a share. Right? So you got a $30 per share loss. So what the IRS will allow you to do is actually take that loss and offset other gains in your portfolio. So maybe you can offset it with some energy gains and rebalance that way. You could also take that loss and purchase an index, because all the indices are down substantially from their highs earlier this year. NASDAQ's down, like I said, 30%. The S&P 500 is down midday here, more than 20%. So those are things that investors can do. Or you could just simply sell the position at a loss and wait for an opportunity to deploy that cash. The one thing that you should not do, and what the IRS will not allow you to do, is repurchase that same position within 31 days. Right? So if you sold Apple at a loss of, let's say, $30 per share, then you have to wait at least 31 days before you can repurchase Apple again.
All right.
Because what the IRS doesn't want you to do is take the loss and immediately rebuy the position just to take the loss in your taxes.
Right.
So the IRS always has, their own rules of how they want you to handle your money. But that's the rule. Now, what you can do, like I mentioned earlier, if you're worried that, I'm going to miss out on the potential growth of Apple shares over that 31 days, well, just go buy the index. Go buy the Qs, which is the whole NASDAQ. Or you could buy the S&P or something along those lines, because obviously Apple is the largest position within the S&P 500. Or you could just pick something similar, like a Microsoft, maybe, if that's already in your portfolio. Not that Apple and Microsoft are going to perform exactly the same, but they do a lot of the same things. So those are things that investors can do to rebalance that asset allocation, actually either take a loss to offset a gain with, or just take that loss, reinvest those dollars, knowing that you'll have a loss to offset future gains with. So that's a process that I think is very successful, have been doing that for clients throughout this year, because this is an inevitable event like we talked about. Losses are an impossible thing to avoid. And the great news is there's some things you can do to help yourself on the tax side, as well as adjusting your allocation in volatile moments like what we're seeing right now. It just doesn't work out well, for IRAs, right? Because you can't take a loss inside of an IRA account. You just simply have to rebalance it. So that's one thing that investors can do. Now, the other thing investors can do, again, is talking about controlling those emotions. So investor sentiment survey from the University of Michigan came out Friday with the hot inflation data that we all experienced and are still experiencing as we're talking here.
We talked a little bit about this on the happy hour.
Yeah, we definitely did. So the University of Michigan, they do these surveys about investor sentiment, and they expected the numbers to come in right around 59. The last time that they did the survey a few months back, it came in at, I think, 58. So they expected maybe just a little bit better in investor sentiment. Actually came in at 50, which that's like end of the world kind of number. Like the last time we saw investor sentiment that bad was 2008.
Maybe the dude was right.
Well, time will tell. We'll find that out, all together here over time. Which, kind of explains some of these outflow numbers that we're seeing here. So according, again, to State Street's data, retail investors are at their most bearish level in the last 3 years. Well, I get the data point. However, the last 3 years leading up to 2022 was awesome returns. You're talking double-digit returns year after year for 3 straight years. Now we walk into 2022 with supposedly the economy reopening. The Fed said they had to increase rates to slow the growth because we've had 0 rates for 3 straight years. And then you get this war in Ukraine going on. And by the way, we are still going to have this midterm election that's coming up. Probably seeing all those commercials already, which are super annoying, but it's an inevitable event as well every couple of years. But yeah, I mean, I get the sentiment, but that does not mean to me that we should all be, just giving up. Like this is inevitable. I think people are just forgetting about the fact that after 3 straight years, stuff like this can actually happen in the marketplace. You have to have a way to handle both the good and the bad. So I mention this to investors all the time. So we started the show talking about asset allocation, right? So maybe you did have the right asset allocation. Maybe you talked to somebody and you're like, yeah, you know what? 75% stock exposure is good for me, 25% fixed income. That type of asset allocation is a classic growth asset allocation. I would expect, based on the history of that asset allocation over a long period of time, so maybe 10 plus years, you could reasonably expect somewhere in that 8 to 10% average annualized return. Actually, history says that allocation average is about 9%, which is great, right? That's awesome. However, if you set up that asset allocation, let's say 3 years ago, maybe late 2008, beginning 2019, something like that, and you didn't change anything at all. You just let it ride, which is what I hear all the time from investors. Like, oh yeah, what'd you do the last 3 years when the market was doing great? I didn't do anything. I just let the market keep riding, which looks good on paper, right? Because at the end of every one of those years, you're talking double-digit returns, and you had 75% of your money exposed to stocks, and it's going to look awesome every year. However, every year that percentage of stock exposure is growing more and more. It's a bigger part of the portfolio. And at this point, if you've done nothing, it's probably getting close to 95% of the overall portfolio before we got to, the mess that we're in here in 2022. So what happens? Well, the market's now rebalancing that person's portfolio for them through this stock sell-off. It's just doing it in an unkind way. And that's where this sentiment data, I believe, this is why a lot of the sentiment is the way that it is because people didn't have a way to deal with the good parts of the market. Knowing that, they should know that, hey, things are going to be good most of the time, right? Statistics say over 100 plus years of market data, market's positive 75% of the time. That also means it will be down 25% of the time too. And I think people just forgot about that. They didn't have a game plan for it, and now they're going to pay that price.
Yeah. I mean, do you think maybe there's another factor also? And we talked about this a little bit at the happy hour as well, but they're kind of new. There are new players in town with crypto, Bitcoin, obviously, and those saw record highs, as did some of the the market returns in the pandemic. Such a crazy situation where people weren't. We all remember what that was, and we're only 16 years out of the 2008 crisis as well. So some folks, this is their second kind of double whammy as far as massively unpredictable, once in a generation economic events, global. So do you think that also has some effect into these numbers as well?
Yeah, there's definitely some of that going on, right? This war in Ukraine definitely doesn't help out with sentiment, right? It seems as though, some of the leadership for certain countries, certain parts of the world, they're concerned about that, right? China could potentially try to go at and reclaim Taiwan as an example,
right?
Which the U.S. is kind of backing Taiwan, and nobody wants to see China, the second largest economy in the world, very strong military, obviously, conflicting directly with the United States, right? Nobody wants to see that. Nobody wants to see another world war,
no,
right? So I think that definitely plays into some of this, and I think additionally to that, because of the war in Ukraine, there will be parts of the world where there's likely to be a famine,
right?
And in the United States, we're fortunate enough where it's just going to cost us more money, to buy that bag of potatoes or some corn on the grill for the summertime or whatever the food item is. It'll cost us more money, but there are definitely places around the world where people will not have bread, just because there's a wheat shortage. So yeah, definitely a lot of that stuff is playing into investor sentiment as well. But I still do think that part of that sentiment survey just simply comes down to the fact that people did not have, a game plan for controlling their allocation. Their emotions were completely in check because the market was moving up to the right.
Yeah.
Everything was cool. But now we're getting the opposite of that so far in 2022. And that doesn't mean that this is going to last forever, right? Mm-hmm. This is not the new normal. This is just a part of being a long-term investor. You have to have a game plan for both.
Right.
And from an investment standpoint, this is probably not a tremendous shock of a statistic, but profitable stocks have outperformed non-profitable stocks for 11 consecutive months as fundamentals have mattered more than the actual narratives. So what does it mean by profitable stocks? It's just simply meaning that the company made a profit, right? They actually have a price to earnings ratio. Whereas there's some companies like a CrowdStrike as an example. Mm-hmm. Love the company. They're in the very first innings of what I believe will probably be a really good run for the company and employees at CrowdStrike and for investors, because this whole thing about cybersecurity, is only going to get more and more important. I already know that when I go to do my insurance annually for Shepherd Wealth Management, and when auditors come in and check out the things that we're doing here, that's a big part of their conversation with me. What are you doing to protect your investors' information from cyber attacks? Insurance coverage is there. You got to pay for that. So all that stuff is going to be probably a big profitable sector going forward. However, CrowdStrike at the moment is not actually producing profit. Every time when they produce their quarterly numbers, they're just trying to lose less and less money to get to profitability. And I'm looking at the S&P 500 heat map here on CNBC, and there's literally only 2 companies in the S&P 500 as I'm sharing this information with you that are in the green. So haven't seen this in quite a while. But this is the type of thing, right, that you're going to see headline news about all this stuff.
Right.
And this is where we get the emotional reactions that come into play here. So that's why we want to do this show, is so that you're armed with information, what's going on, why is it happening, and what can we do about it.
Yeah, and we're all grateful for you sharing that information, because as I was mentioning earlier and just projecting my own situation onto someone else, I definitely have those emotional reactions. I mean, we all do. And for anyone listening, there's not a better place to get together and to talk about them than on the SWM YouTube channel.
Absolutely. Which means I think that we should be answering some questions, I think, for some viewers at this point.
We have had some questions come in already for the show. So
all right,
you ready for that?
Lay it on me.
All right. Well, new texter, Stacy from Louisville, using the dip to pull out my buy sheet, exclamation point. Do you have any recommendations for how to establish personal buy thresholds? Can't time the market, obviously, but don't want to miss out if it goes down further. Also don't want to spend all of my reserve cash at the wrong time.
It's a great question. So where do I get an indication for an entry point? Well, one of the things I'm doing right now to try to help answer this question is I'm going to take a look at what the VIX is telling me. So the VIX is just a volatility index. Think of it as the fear gauge. It's just a bunch of options contracts tied to the S&P 500. And it basically gives you some indication of how investors feel about the market in the short run, what direction they think it may be going. And generally speaking, now the VIX can go 60, 70, 80. I mean, it has done those things like 9/11. The VIX will spike up to a dramatic number. Mm-hmm. The pandemic, March 2020, so the VIX was way up there. Right now, as I'm talking, is 34.1. Generally speaking, when the VIX is at 30 or above, it's a decent time to look at your buy sheet. When it's 35 or above, you might not be catching the bottom. Like I don't try to catch the bottom. It's a process that's not going to be consistent. Even if you happen to catch the bottom, you won't be able to consistently repeat that. But when I see a VIX that's approaching 35 or going past that 35 threshold, that's usually a pretty good indication that investor emotions are running pretty high. It doesn't mean that you're catching the bottom. Market can still go down from there. VIX can go much, much higher. But it's usually a decent indicator that, hey, this is a good place for me to start to apply some capital. So what I'm actually going to be doing for clients after this show is over is I'm going to be pulling out my buy sheet, and we're going to rebalance some things. And for those that have cash on hand, we're going to deploy, I should say, a little bit of that. So the other part of the answer, I think, too, is that you shouldn't, unless you are young, have got a huge time horizon, you already have an emergency fund, and you have plenty of cash flow to cover your lifestyle and to continue to invest. Like if you knew that you were going to contribute, every single week or biweekly to your investment account, that you could consider pulling the trigger on, let's say all of the cash in the portfolio and investing it into the asset allocation that you feel is appropriate. But for me and my clients, again, I'm not trying to time the bottom, but this is probably not the last day that we're going to see some volatility in 2022. So I'm going to deploy a little bit of capital into positions that we think in the long run will benefit from the inevitable recovery after these types of events happen. So hopefully that helps. But I always start with the VIX, and you can get more technical looking at 50-day moving averages, 200-day moving averages, kind of get an idea of an attractive entry point. But I don't look at just technicals. Let me be very clear on that. I just kind of use technicals to give me an idea of, are we getting a decent entry point here for the position? By far and away, the way that I go about picking positions for myself and therefore my clients has everything to do with fundamentals. That classic, Warren Buffett type of analysis of balance sheets and income statements and price to earnings ratios and PEG ratios and all that fun stuff. I enjoy. I think it's fun anyway. But that's how I go about making the decision on what companies I'd like to have and when I might want to get out of a particular company for some specific reason that has to do with their fundamentals. So the technicals, though, that'll give you a decent idea of where you might want to consider entering a position.
Right on. Well, thanks for the question, Stacy. Returning texter, I should say, Brian from Shelbyville.
Man, this guy's my man.
Yeah. Well, so Brian's saying, you've been talking about it, preparing us with positivity and strategy, but now that it's here, I'm freaking out. I don't really have a question, but what do we do?
Well, it sounds like Brian and I need to get an appointment on the calendar here.
Yeah.
More than anything. But so that's the other point too. Like when we would ask clients, when I was working at a TD or a Fidelity, and even still here today, you ask them about how they manage things in their portfolio. And oftentimes it's, I just kind of set it and forget it. But then you get these periods of time like what we're experiencing right now. So I would say if you do not have the time or the desire or the skill of expertise of being able to look at balance sheets and income statements and, 10Ks and, doing a good analysis of the board's management team and the CEO and the CEO's track record, like if that's not fun for you or you don't have the time, then that's one reason that you would want to consider working with an advisor, right?
Right.
The other reason, and probably I would say more important than not having the time or knowledge or skill level to do your due diligence on companies or doing like fundamental analysis like I do, the other primary reason why people hire me or probably hire an advisor in general anyway is exactly what Brian's talking about, right? He's got no control over his emotions. I understand that. Again, I'm a human being. I feel all the same things. And when I pull up my portfolio, when I pull up my entire client list of portfolios and you see nothing but red, it does not make you feel good.
Right. Yeah.
Right. But you got to take this into context. One good thing is that we're doing better than the overall averages, right? So that's positive. We're beating the market on the downside, which typically would mean since we have a smaller hole to dig out of, and we're doing things like tax loss harvesting, and we're doing things like rebalancing the asset allocation from positions like energy, from our healthcare positions, from our Berkshire Hathaway position, which is an awesome stock so far this year in 2022. we can shift some of those profits into other parts of the portfolio, but you have to have the right temperament to do that. It's not a natural thing to go in and buy stuff that everybody else, it seemingly wants to sell, right? But do I think Amazon's going to go out of business because we happen to have a recession here, or I should say a bear market in 2022? No, even if we do have a recession, those are the kind of companies that are going to be the most fine because they make money in so many different ways. They're so large of an entity.
Right.
Whereas, if you got these small companies, and I don't want to pick on Zoom, but I'm going to, Zoom really does one thing. It gives us a way to communicate virtually, seamlessly, share information, via the cloud, right? The internet. That's the only way that they make money, right? They don't have other ways that they're generating a whole lot of profitability, whereas, Amazon has e-commerce, they have the cloud business, they have their advertising business, they have a whole bunch of businesses in and of itself.
Yeah.
Same thing with a Berkshire Hathaway, right? Berkshire is a mutual fund all by itself, right? Even though it's a publicly traded stock. They own Apple, they own railroads, they own, insurance companies, so on and so forth. So many different sectors just with one position. So if you can't control those emotions, because it's, again, not an easy thing to do, is shifting out of profitable sectors and buying things that seemingly everybody else wants to sell, that's a great reason to consider giving an advisor a call, giving me a call. I'd be more than happy to meet with you, Brian, and see what I can do to help.
Yeah, especially since Brian is one of probably, I think, if our only returning texter.
It's consistent.
Yeah,
I'll
Brian's
say that.
in most episodes. So
for a guy I haven't spoken with, he's pretty consistent.
And Brian, I feel you, man. You, me, and the dude, we should all go get a beer. We're all in the same boat right there.
Friday happy hour. We already got a show for that.
That's right. We'll see you guys on Friday. Thank God we have Joshua piloting the ship. Just remain even keel. I think we got time for one more texter. Also from the first texter line, Kevon from Louisville. This is an interesting question. I'm not sure how much you want to go in on this, but he's seeing a lot on TV today about SPACs. What is that, and why are we hearing so much about them right now?
Yeah, don't buy it. So it's a special acquisition, basically a way for a company to go public.
Yeah,
right? Become a private company going public. Generally, very highly leveraged sort of situation. I am having a difficult time rattling off a name of a recent SPAC because we saw a whole bunch of those, over the last, I'd say, 18 months. Definitely saw a ton of them last year. I can't think of one off the top of my head that's had a positive result for their clients, right, from a performance standpoint. It doesn't mean that there aren't any. I don't have any on my fingertips. There probably is some. But a lot of them, definitely have had pretty bad performance, certainly worse performance than even what we're seeing here on the major averages. So I would definitely say, do your homework, right? If you're going to, consider that as a part of your positioning for your asset allocation, do a ton of homework. Make sure you really understand the risk of what you're getting yourself into there. It's definitely something I don't have for any of my clients, which is why I'm not able to rattle off anything that is really great to say about a SPAC at the moment. But that doesn't mean that there won't be really good ones in the future, and that doesn't mean that some of the ones that have performed poorly won't ultimately turn themselves around into a profitable position for somebody. So I would just say do your homework and understand the risk before you get into something like that. But interesting question. In this volatile moment in time, I'd say that that's probably something I might give the Heisman to, at least for the moment, because there are so many other places that I could park capital and feel really good about the company because they are profitable. They've shown a long track record of profitability. They're just taking on the nose just like every other company out there in all sectors is taking on the nose, with the exception of energy. So good question, interesting. Maybe we'll have a more in-depth conversation about SPACs at some point. But
yeah, for sure. Well, I think that might be all the time.
Yeah, no, I really enjoyed this podcast. It allowed me to get some of the stuff off on my chest and my shoulders. But the data here is outstanding, and I can't wait to put this to work for clients here in just a little bit. So I hope you all enjoyed the show. Don't forget to like and follow Shepherd Wealth Management on Facebook, Instagram, and Twitter. Again, make sure you check out the Financial Shepherd podcast on YouTube and Spotify. You can also go to my website, shepherdswm.com. There's a whole bunch of information about myself and my background and experience. And of course, at the top of the website, there are links to our Spotify and YouTube channel, so you can check all that out. Subscribe to the channel. That way you get the alerts on your phone when we post new shows like the Financial Shepherd Happy Hour on Fridays. And of course, feel free to share it. If you have friends, family members, loved ones that are having a difficult time kind of understanding what's going on here, how to control their emotion and temperament, I think this will help go a long way for that. So really enjoyed it. Make sure you keep sending the questions our way. It's for our Friday happy hours, 513-630-2664. Hope you all have a great rest of your week. We're signing off.